Hi, this is Paul Rosta, the host of CPE's Investment Matters. If you enjoy this podcast, I hope you'll check out CPE's Capital Markets newsletter, our free twice monthly roundup of the latest trends, analysis, and data in commercial real estate investment. It's easy to subscribe. Just go to commercialsearch.com/news/subscriptions. Again, that's commercialsearch.com/news/subscriptions. In just a moment, you'll hear my conversation with Lisa Pendergast, President and CEO of Commercial Real Estate Finance Council. You'll hear Lisa's insights on today's capital markets trends, as well as her rather unconventional path to leadership in real estate finance. Take a listen. Lisa Pendergast, welcome to Investment Matters. Really nice to be with you today.
Thank you so much, Paul. I'm happy to be here. Look forward to the conversation.
Well, this is a very timely conversation because you just came back from the CREFC conference in Miami a couple of weeks ago. And so could you tell us a little bit about what the mood was like at this national event overall, and maybe share a few of your main takeaways from what you were hearing during the conference?
Absolutely. The conference was truly spectacular and in some days a bit overwhelming. We had a significant number of people attending all over the place, either within the conference room itself, where the sessions were going on, all of these cabanas that were set up for individual company meetings with their customers and their clients, as well as just many who were there who were focused on commercial real estate, but maybe not necessarily involved in CREFC, but to the extent I've never seen, and I've been going to these conferences since I was a very young woman. In my 20s, and I've never seen a sort of a turnout like this. So I say that not by reason to brag that we had so many people at our conference. More importantly, I think it was indicative of the sort of positive vibes in the market today. Not everything is perfect, and yet to the extent that there's significant more clarity on certain asset classes and what their outlook and eventually how it's all going to sort of settle. There seems to be growing clarity, not 100%, but it seems to be better, as well as, what the Fed's doing. While they've not been super aggressive at easing, I suspect, the three that they've done at 75 basis points is decent enough for people. So you have a 3.5, 3.75 rate on Fed funds. I suspect that the Fed will continue to be a bit cautious in terms of further easing from here. Although, of course, all of those folks in Miami were very hopeful that we'd see, another 50, 75 basis points. But, I'm not sure that the data truly supports that right this minute. Other things that we talked about in terms of the conference, though, I think the atmosphere is as good as it's been in a bit, in a good long time, to the extent, and as I say, it's not all about the Fed, but I think it's that we have a greater sense of understanding of the various asset classes, how they're performing, even the office sector. To me, if you look at, our delinquency rates, office has the highest delinquency rate right now at around, as of December, around 11.3% or so. And that, really is significantly higher than almost everything else that hotel, retail, multifamily are around 6-7%. So, we've seen improvement, and yet there will be assets that simply don't survive in that office sector. And we'll start to see, I think it's been sort of extended pretend. I don't love that saying, if you will. It's really about giving an asset time to recover and see if in fact that works. And so to the extent that, we've, I think, seen perhaps the worst of the office, sort of build up, if you will. And now it's just really about whether or not some of these office properties can convert. Does it make sense to, the owner, the current owner, and anyone else who's going to take over that asset, convert it into multifamily housing? To my mind, though, I recently participated in a session at SHAC, and I had Bill Rudin's daughter was one of the panelists on my session, and I was shocked to hear just how much, though, they're doing in these multifamily, office to multifamily conversion. And I think it's phenomenal. It's important for the city. We are in a shortage of housing stock. And so to the extent that you could do some of this, if it's making sense, clearly anything that you would do would need to make financial sense. And so in cities like New York, that seems to be something that actually can happen and be accretive to the housing stock and to just quality of life in New York. So that's something that, the conversion issue was also discussed. Clearly, I think there's a lot of questions as to where we are from an economic perspective. We've seen some Fed easing. They've moved 3 times. We need more data, and I'm sure they need more data before they were to move again. But that's a concern, because if you think about the volume of loan maturities that are out there, right now I'm counting in 2025, there was $957 billion. And I dare say some of those probably moved into 26, where the number is down to around $663 billion in loans that are maturing. Then that's across all lender types. So to the extent that a lot of those loans, though, are coming in with coupons that are 4%, some even high threes, the reality is now you're talking about something that's significantly higher by 100 basis points. So there is that sort of pinch point, if you will, in terms of financing markets, where, you're going to have to do a variety of things. So the Fed moving is helpful. More of that, I think, is still needed to get folks to a point where they're not truly stressing in terms of the absolute level of the mortgage rate. And so, having said that, are we all super sort of pound the table that we're going to see a lot more? And it just, to me, it's not clear. It's not like you can say, I anticipate that that's going to do another 320. They're not going to move for 75 basis points at any time soon. They're going, if they do it, I think they'll take their time, and they want to see the sort of the response to what they've done so far. And if they feel that they need to do more, they will. But I think they're going to do this in a very conservative, discreet kind of way, and waiting on the data and watching with them.
And by the way, just a quick note for our audience who may be outside the New York metro area. A few minutes ago, when Lisa was referring to the conference event at SHAC, that's the SHAC Institute for Real Estate at New York University. So it's a very, obviously, a prominent resource for commercial real estate and for the business. So, Lisa, another reason why this is a very timely conversation is because as we are speaking today, it was only a day ago when CREFC published its quarterly sentiment index.
Yeah,
Had some quite interesting findings. And I'll just mention one headline, which is that the overall index ticked up significantly from the third to the fourth quarter and is now approaching the all-time record. All that said,
it was the third consecutive quarterly increase in the index.
Oh, is that right?
I think if you think back quarters, that was the pivot point where folks started to feel that things are settling down. And, we've seen some, like I said, some move from the Fed, some clarity on certain asset classes. I mean, that's going to continue. And I think in office, it's just going to be a slow grind. Do we get to some steady state and understand where we are with the office sector and what's needed and what's required, what's not needed, probably most importantly. And then you'll see those convert to multi or whatever. Sorry, I didn't want.
No, I just want to give you a chance to touch on any highlights of the survey.
From the conference, I think there was, to me, there was, it was a very constructive event. The panels really focused on, how you block and tackle in this current environment, on a variety of fronts. So it's not just most of our folks at that conference are those who are lenders, those who are investors in securitized, commercial and multifamily loans, and then all of the third, fourth, fifth parties that are involved, right, with putting together a transaction, closing a loan, all of those things. So to me, it's always vibrant because of the sort of dichotomy of individuals who are in the room during these sessions. Mm-hmm. And so to the extent that I believe what we always try to deliver is a little bit for everyone, right? And hopefully more than just a little bit, but making sure that we cover all the food groups that are in the audience who are at the conference and making sure that we're covering sort of the issues du jour. In some ways, I've been to some of these conferences long before I was at CREFC. I spent over 25 years on the research side and sat on a CMBS trading desk. And so in that regard, it's really a capital markets conference. It's a lending conference. It's an investing conference. It's a variety of things, investing in the actual hard assets or investing in a CMBS deal or a CRE CLO deal. It kind of pleases me to see that the CLO market has really grown substantially. And it certainly serves a niche that was missing in some ways. The financing of transitional assets. And then there's a great ecosystem from, what you do with that transitional loan and you stabilize your asset. And then you have all of these other pockets of liquidity from various sources that can take you out of that transitional loan and put you into a stable one. Be it fixed or floating, whichever it might be.
You've given us your thoughts on what the Fed might do this year and the prospects for interest rates, but how about some other economic indicators? What else are you monitoring right now?
I mean, for general purposes, we just clearly looking at any sort of measurement that gives us an indication what the Fed's going to do next, right? So all the, sort of inflation data, PPI, CPI, it strikes me that, and I think most are in agreement here, that the economic data hasn't really been a super, super powerful argument for easing further. That doesn't mean they won't. I think they've been very cautious and slow to do that. So to the extent, though, that I believe that it's going to be, again, just a slow process, I suspect at some point they may ease again, and that could be in a month, 3 months, who knows. But the reality is that this is a cautious Fed, and I don't see them not being that way. Not to add sort of politics in this, but clearly we have a president who wants the Fed to ease, and I am kind of happy to see that the Fed is going to do what they think is right and at the timing that they think is right.
I wanted to follow up on an issue that you touched on a few minutes ago, which is the conversion of commercial properties and especially office buildings to multifamily. What are you hearing and seeing out there right now, and anything that's new that you're seeing these days with these initiatives, with what certain municipalities are doing that are leading the way, or other strategies?
I haven't heard much of that yet, and it's something that, frankly, I need to probably get on and start making outgoing calls for inquiries as to where that is. But if you look at even just the sentiment at the conference, I thought was interesting in that it seems to be, for some, a far more embedded thing than I think a lot of us thought. And, for example, I worked at Jefferies for a bit, and Mary Ann Gill-Martin was one of the speakers. She's an owner of commercial real estate, and she was talking about these conversions and certainly embracing them, as were the other owners, borrowers on her panel. And so that struck me as something as, okay, this is a green light that probably will, entice certain developers, owners to do. And to the extent that, we're trying to gather data on what various cities look like and what they're doing, how much volume are you seeing, is it economically feasible to do this, and in which case is it feasible, in which case isn't it feasible, questions like that. And to me, that's something that we at CREFC, from a research perspective, need to really sit down and dig our heels in and figure out, at least what we're dealing with in terms of scope. And I read recently that it came out of the mayor's office, I think, that there are already some 70,000 units that are already in line to actually see those conversions happen. And clearly, New York City, Manhattan needs more housing supply. So to the extent that if this works, it makes a lot of sense. It was interesting because if you taught this conversation a year ago, there would be at least 50% of the folks that you sort of queried would say it's never going to work. And another 50% thought, yeah, I think it can. So I think in many ways, the breadth of it is still to be determined. And yet the more that you do will beget more and more projects similarly to that. And it will, one of the things that CREFC has been focused on is the affordable housing side of things. For a long time when I was on the street side, one of the things I focused on were Ginnie Mae project loans. And I always talk about this. I think people are getting tired of hearing me, but it is the perfect affordable loan. It is a 35, 40-year fully amortizing loan that you can do many things with. There are multiple programs within that. So, I mean, it's an interesting thing. I do think Ginnie Mae in this segment probably needs to become a bit more efficient and sort of market focused. And if they were to do that over time, and it doesn't happen, in a second, the reality is that, I think you'd see a lot more Ginnie Mae project loans being issued. And, it's an interesting sector of the market. It's full faith and credit. There's nothing wrong with it, in terms of other than it being just sort of always out there, somewhat afar from the more sort of mainstream lending programs. And the fact that it's underutilized to me makes not a lot of sense, except that they do need to have that injection of let's do this faster, let's do it, sort of more efficiently, and, both from a process perspective and possibly.
Well, let's change gears if we could. Could you, I'd like to hear more about your own professional journey before you took on your current role at CREFC. As you kind of alluded to, you've held senior positions at several major financial institutions. You've written technical articles on finance for academic journals. But how did your interest in the intersection of finance and analysis get started in the first place?
So, interestingly, my goal was to go to undergraduate school, and where I was blessed with a scholarship. And then I wanted to go to law school. And I started to look around, and I realized first you might need to get a job to pay for that law school, whatever it might be. And I started working literally I was an English major. And so you say to yourself, what do you do with this? So I started to work I found a job at Securities. I started in publishing. I was there for about a year and realized I could not support myself on publishing. So one of my friends worked at Prudential Securities and said, they're looking for a writer. Would you like to go? And talk to them? I said, sure. So I walk in, and it was the financial strategies group. 3 of the folks that I interviewed with were professors in all sorts of crazy. One was a rocket scientist, literally worked for NASA, came to work at Prudential Securities. And they had all of this is when we were introducing things like option adjusted spreads for mortgage pass-throughs, trying to determine, the sort of the prepayment schedules and the like, and what that might look like based on your coupon, based on the type of loan. And so what they would do for the first year of my career there was they'd throw me in a room with one of these rocket scientists, and they would talk to me, and they'd say, okay, now go write it. And it was an education from a bunch of PhDs in math and science and everything else. And to me, I always joke with my kids that, you cost me a hell of a lot more than I cost my parents when I, got this free education from the PhDs at Securities. But to the extent, though, that to me, I immediately fell in love with that intersection of hard assets, understanding, those, right? And then the whole math behind all of that in terms of the financing side. It just immediately captured me. And so it's something that I started and didn't anticipate that I would continue for 30 years of being a research analyst. But I loved it. I loved the digging for data. as well as then the ability to hopefully convey that to people in a way that's meaningful, that is understandable as well to anybody who needs to understand.
Well, it really sounds like, though, at the start when they threw you into the room with those rocket science, it was one of those deals like, best of luck. We'll see you at the end.
I have to say, I went home, I think, I was dating a fellow at that time and said, I don't know how this is going to go. But, those people I still speak with, and I would say that to the young people, like, learn from those who came before, and become, it's so much nicer to have friends within, the community that you work with. We spend 12, 14 hours a day back then, in the office. But to the extent that it was a great education, and it's something that I used to have a teacher that used to say something that used to always bother me because it seemed inappropriate. He'd say, well, you got to scratch where it itches. I thought to myself, what does that mean? It just means if you're interested, pursue it and really focus on it. And so I kind of got hooked on, commercial real estate, but I did all different asset classes. I did Fannie Mae, Freddie Mac pass-throughs. I did CMOs, all sorts of things. It was interesting. It was a great learning experience.
Yeah, it sounds like it was a pretty valuable education in itself to have to,
It was the cheapest, MBA anybody ever got.
Yeah, for sure. Hi, Paul Rosta here. I hope you're enjoying this episode of Investment Matters. For more great investment and finance content, subscribe to the CPE Capital Markets newsletter. Just go to commercialsearch.com/news/subscriptions and subscribe today. And now here's the second part of my conversation with CREFC's Lisa Pendergast. I'd like to hear your take on a couple of other finance trends. Are you seeing any shifts in real estate capital sources, for example? Like, are any lender categories that are noticeably stepping up their exposure in commercial real estate right now?
Yeah, I think the sort of introduction of commercial real estate collateralized loan obligation on the CLO front, that to me is something that had been lacking from our business, which was mostly stabilized with financing of stabilized assets, with the exception of Ginnie project loans, which had a construction loan piece and a permanent loan piece. Other than that, there wasn't a lot of construction lending in the securitization market, that's for sure, right? So to the extent now that you have, these blossoming numbers of debt funds out there that finance themselves via the CLO market, it has become a really strong market. It's predominantly floating rate. And to the extent that I think, it appeals and it's shorter duration than what you see in a CMBS transaction. So there's a whole new sort of bucket of commercial real estate securities out there that appeal to a variety of different investors. And so it's a bank product. It's anybody, certainly on the floating rate side that's interested in focusing there. And so, to the extent that those CLOs, it's a great feeder into a permanent loan, correct? So it doesn't need to be a CMBS deal, although oftentimes it will be just because it came from the securitization market. It's a universe unto itself. You kind of would move from financing that transitional loan, it stabilizes, and then it goes to something either in the conduit market or the SASB market if it's something large. So to the extent that I think the evolution of the CLO market is a great thing. First of all, it provides investors who need floating rate product with a bigger bucket now of floating rate products to purchase. You have SASB mostly floating rate, so there's that. But that's if you want to have that diversification that comes from multiple loans in a pool, then the CLO market is the thing to do. And so I think it's important that we've opened up this other market in the CLO sector. And have done it internally late, but traditionally it was more bank product, and I think now you're starting to see it spread out to different sort of facilities. So that's an interesting. The CLO market in and of itself, the fact that it's grown to be pretty good. I just look at some of the data here. It's this year, and it's very early, but in 2025 we saw $91 billion in SASB, the single asset, single borrower deals on the CMBS market. We saw much less conduit at around $34 billion. I personally would love to see that market get back to sort of where it used to be. Maybe not quite so much. This is what drove us through the bad times, but certainly, something more than what it is today. And we'll see how that works out. But if you also then look at the CLO market, in 2025, we had about 31 billion. And that compares to the CMBS market, as I said, at 126 billion last year. And so, I mean, the numbers are good. And I think that the investor base is content, generally speaking. And that's where I think sometimes CREFC comes in. We continue to upgrade, working with our members, the investor reporting package for the CMBS market. We recently released the Collateral Manager Data Report, which is for the CLO market. So it's like the IRP, but it is for the CLO sector. And what we know from all of this is the more transparency you can make some of these securities and these securitizations, the more, sort of liquidity you have, the bigger the market, the bigger the investor base, the whole thing. And so I've always been thoughtful about how, even before I worked here at CREFC, how with CSSA, with CMSA, it was a whole bunch of different names as it grew. So to the extent, though, that you need institutions like ours to say, let's get a whole group of people together. Let's create this report that gives the transparency that you need in order to grow the investor base, ensure that you have liquidity in the bonds, once you own those bonds. And so that's one of the major roles I see as CREFC, sitting in the seat at CREFC, is that our job, I think, job one would be to create as much transparency as we possibly can for all markets, be it for, the banks and the like, as well as the one thing I know it wasn't the question you asked, but I will say that, what we've found is that working in DC as well, and that's sort of one of the fun things I get to do now, because I always wanted to kind of do that in law school or whatever, but to the extent that, we visit the Hill often, we have Syra Berkey and David McCarthy, who are just excellent. Syra does all of our regulatory work. David does all of our sort of legislative work. And to the extent that what I learned which was something that I didn't know, is that when you change whoever is in the White House from an R to a D or a D to an R, they kind of go through all of these regulatory bodies and put their folks in those seats, which is their right to do so. So today, when we have more Republicans in those seats or right-leaning people in those seats, no one's doing anything untoward on either side. It's more about having a better sense of how to move, maybe business forward. So to the extent that some of the regulatory burdens, especially around the issuance of the CMBS, are just so overwhelming, not only in time-consuming sort of issues, but also cost. It drives everything up, and it just takes long. So to the extent that, while we'll kind of strike while the iron is hot, so to speak, and be in there speaking. And my view is we go in there, and I always tell everyone, no one needs any hyperbolic statements. We need factual information as to why this works. And if it overall does work, what are the pinch points that maybe you could make easier for the market, or, while still holding the integrity of the regulation. And so that's been an eye-opener for me over the years being at C. But I have to say, I very much like going to the Hill and speaking to congressmen and senators, as well as to regulators, as to what's going on in the market. My as a research person and, now sitting in the seat, feel it's our job to get out there and state the truths and say it with, and if you don't believe me, well, I'm coming with all of these facts and figures to say, here's why. And so, I think that's a role that CREFC plays and plays well. And like I said, our GR team is, they're the best and really focused on the issues that impact our members first and foremost.
And talking
this
about
is not
policy,
an advertisement for CREFC. It's just that those are the things I feel good about when we think about the organization.
And speaking of policy, could you give a for instance of any sort of issues that are at the top of CREFC's agenda right now, even if they don't necessarily tend to get a lot of headlines, but you think are really important to the business, to the industry?
Yeah, I think a lot of that has to do with, as I just mentioned, some of the SEC regulations. And a couple of things there. I mean, I never look at this as these are individuals or a regulatory body that's looking to do something that's not accretive to a business, right? However, their job is to make sure that they find the pinch points, highlight them, correct them if they feel that they need to be corrected. And so, some of the SEC rulings recently have, you sort of scratch your head a little bit and say, most importantly, what problem are you solving? And if you are problem solving, is this really the best way to do it? And you need to do that in a way that walk into that room, talking to that regulator, understanding they're doing the job that they were assigned to do, right? And that's their role. And so to the extent that we have found is, reasonable people can, disagree, but, hopefully more often than not, you actually get to some point, even if it's not all the way there, right? So I do think one of our roles is focusing on legislation and regulation is one of the more important ones because it can significantly damage an industry if there's a regulation that just simply doesn't allow us to do what it is that we do. And so, and as I said, I never walk in there assuming that these regulators are looking to do something nefarious or wrong or too overbearing or whatever. It's a matter of just we understanding what they need and what they want to see as regulation, and therefore what's reasonable to provide that doesn't shut down a business or doesn't do something that wasn't intended.
Yeah, and regarding a policy issue that probably has made headlines and will make headlines in the future, I think. What's your latest thinking about the future of the GSEs? Is that something and is there any movement that we're going to see in the not too distant future? Does it seem to be, pretty still kind of far down the road as far as what's next? Or
it's interesting. This is to me, we've been on the issue. We've had sort of many meetings with our GSE forum as to what has to happen. We actually just launched a GSE study group to try to gain some level of consensus of what people want to see. The problem with that is there's not a lot of consensus. There's also, I think, a lack of sort of movement such that you understand where the platform is today, and what are the pinch points, what's good about it, what you absolutely want to continue to have, and what you want to, like, maybe we need to refine, right? So there's a certain level of discussion there. There's always been discussion about, so for example, the CLO market is doing a significant portion of their loans in the multifamily market, but that's transitional. So arguably you could go to a regular bank loan, you could do a CMBS loan, you could go to the GSEs themselves for that. I think the lack of clarity as to what sort of the president wants, what the House, the Senate wants, and how this all works, and more importantly, what the regulators want, are something that, we meet with folks at the FHFA, once a quarter, just to give them an update on what the market's doing. And that's pretty much, they're lovely people. And it's a quick, hour and a half meeting, and we provide them that. So they being informed, and I think they're informed even well before we get there. They're smart folks. I just think we're in this gray area where you're not hearing as much activity as you did when we first started talking about the GSEs under the Trump administration. So to the extent that, I believe Treasury had 3 meetings in the month of September in DC in their offices where they brought all of the participants in the commercial real estate market together, and, just talked it through. I like the Treasury for this. They're really good people there. And so they just wanted to put people in a room and let's see if we can't, hammer something out. Reality is it's a really tough topic. And half the time you could say what you'd like to have happen. But the reality is that gonna be taken up by, FHFA, and are they gonna move forward with that? So, my view is we keep talking. We have about 30 people senior people that are in this group. And, we'll get there eventually in terms of what do you want to see? I mean, clearly my view is they should have been released from conservatorship a heck of a long time ago. It makes no sense the way, from a business perspective, why would you do something like that for so long? I mean, there are good explanations on both sides for that. But the reality is that I think they do good work, and to get them back in the flow with a better understanding of their charter and sort of the guidelines to better sort of determine what the volume of lending they're going to do, and to think about that in a more robust way in terms of bringing in, and I think the president has talked about this a bit too, more of an affordable focus. As I mentioned, the best affordable loan is in Ginnie Mae, in my mind, from a government perspective. Right. And so to the extent that we'll see how this plays out, but I get the strong feeling that unless there's some major edict that comes, in the next month, 2 months, 3 months, that this is going to be a long slog to figure out how you want to move these guys out of conservatorship and what changes need to be made at both of those. The other thing I've always thought about from an industry person when I was working in the industry was, how much multifamily, for example, and that's what we focus. When I was a young person, I did a lot of single family, NBS, and while it was okay, I always found the multifamily stuff a lot more interesting and the commercial real estate stuff more interesting. But to the extent that going forward, I do think we need to focus on the affordable side more within the GSEs. To me, that's really what a government body should be doing, or a quasi-government body should be doing, because there's plenty of private, sort of sources out there to do the things that they can do, right? And so let's focus exclusively on how you generate more housing. And so to the extent too, I know this is a little crazy, but maybe not so crazy, which is that I would love to see the GSEs do some form of construction loan, just like Ginnie Mae does, right? So to me, if you're really looking to enhance housing, then why not do something like that? Now, construction loans are far riskier. You would need to put a lot of sort of bells and whistles around that. But I think that, to me, if you think about the one key problem in the country, is one of them, the top one is housing, and affordable housing. So it's going to be a challenge, but it's something we're going to continue to chat about in DC and with this group, and hopefully come up with a couple of suggestions.
Well, Lisa, now we come to one of my favorite segments of Investment Matters, which we like to call Executives Off the Clock. None of us can work 24/7, although it sure seems like we try sometimes. So when it's time to take a break from the daily grind, is there anything that you like to do for a change of pace?
Yeah, I think I mentioned earlier, avid bike rider, paused during the hip replacement and went back on the bike. I love to golf, not well, but I still have fun. We giggle, we, have a beer in the course. It's like a fun day, not a winning day, but no, I actually love to golf, and I've gotten pretty good, just in my own sphere. Trust me, and it's just a certain amount of people that I play with, and my son, my son-in-law, things like that, my husband. But the other thing I love to do is garden. It is my favorite thing. My husband gets embarrassed. He's like, it looks like I send you out to work in like the fields out there. It's like, you don't need to do this. It is my joy, and it is my sort of just peace, if you will. I love working with plants and landscaping and all of that. And I often think to myself, you could have run your own landscaping business and been happy. This business is fun. So yeah, no, that's my it's really also just spending time with my lovely family. It's a blessing, right?
Sure.
Not to, to use that time, judiciously, and make sure you spend the amount of time that you like. My daughter's getting married in October. We're planning that wedding.
Oh, very exciting. Well, congratulations.
Yeah, it's all good. And, you've been wonderful. And hopefully we can at some point grab a coffee or something, lunch or whatever. let me
Yeah,
know.
that sounds great. And in the
Yeah,
meantime, Lisa, really appreciate your taking time to visit today and talk a little bit about what's on your mind with Miami and the index and all kinds of things that are happening out there at this very busy time in the
it
business.
certainly is. Yes.
So thanks so
Okay.
much for the time and hope to catch up with you again soon.
Excellent. It's been a pleasure. Take care. Have a good evening.
That was my conversation with CREFC's Lisa Pendergast. You'll find more CPE podcasts on our website, commercialsearch.com, and be sure to follow us on Spotify, Apple Podcasts, and YouTube. And commercialsearch.com is also where you'll get more information about subscribing to CPE's investment and capital markets newsletter. Until next time, thanks for listening and be well.